If you think AI is the safest bet in tech right now, you are about to witness the most expensive reality check in modern financial history. The numbers are in, the cracks are visible, and the people who built this narrative are hoping you never find out. Billions are evaporating. Valuations built entirely on hype, not profit. We tracked 5 brutal warning signs confirming the AI bubble is finally cracking. Here is what they are hiding. OpenAI's financials reveal a story that no marketing narrative can hide. The company's most recent valuation hit $730 billion. An eye-watering figure for a business with no audited profit and only $13.1 billion in projected revenue for 2025. That gap is not a rounding error. For every dollar OpenAI brings in, it spends roughly $1.69. Analysts estimate operating costs will top $22 billion this year, with losses for 2026 forecast at $14 billion. Internal forecasts stretch the pain further. OpenAI does not expect to reach profitability before 2029, and by then, cumulative cash burn could exceed $115 billion. Sam Altman, OpenAI's CEO, has not denied the scale of the challenge. He has publicly stated, though not in any verifiable filing, that the company will require more capital than any business in history. Even the $110 billion raised in the latest round is not enough to close the gap. The numbers are not projections from skeptics. They come from OpenAI's own statements, financial filings, and analyst breakdowns. This is not a company running lean. It is a company burning through cash at a pace that dwarfs any previous tech boom. The disconnect between OpenAI's valuation and its ability to generate sustainable profit is not a footnote. It is the prototype for the kind of bubble economics that defined the dot-com era. Only this time, the numbers are an order of magnitude larger. Microsoft, Google, Meta, and Amazon have unleashed a capital spending spree that dwarfs anything seen in previous tech cycle. In 2024 alone, the combined AI infrastructure budgets of these 4 giants topped $250 billion, according to industry estimates. Microsoft's internal projections added another jolt, raising its annual AI capital expenditure by $50 billion in a single year, and pushing its fiscal 2026 AI-focused capital expenditure to $145 billion. Alphabet's guidance for the same period set a range between $175 billion and $185 billion, with nearly all of it earmarked for Google Cloud's AI compute and DeepMind research. Amazon and Meta followed suit, each laying out plans to double or even triple their AI infrastructure investments, chasing the promise of future dominance. But the returns remain elusive. Despite these historic outlays, none of the firms have published detailed return on investment calculations for their AI spend. Instead, earnings calls are filled with high-level claims. Azure revenue is up, Google Cloud is showing growth. Meta is touting improved ad yields, while the actual payback period for these investments remains a mystery. Wall Street analysts, including Goldman Sachs, have started to question whether this level of capital commitment can ever be justified by near-term revenue. The memory of Google's Bard demo, wiping $100 billion off its market cap in a single day, still lingers. A warning that even the biggest players are not immune to sudden shocks. With AI infrastructure spending now measured in hundreds of billions, the risk has shifted from a single company's balance sheet to the entire tech ecosystem. The cloud giants are locked in an arms race, each betting that scale alone will deliver an edge. Yet as the gap between spending and proven returns widens, the patience of investors is wearing thin. Chief information officers who once championed artificial intelligence pilots are now pulling the plug in record numbers. According to Gartner's latest survey, 30% of enterprise artificial intelligence projects never make it past the proof of concept stage. The most common reason is the data is not ready. 60% of failed initiatives stall out before deployment because companies discover their data is too fragmented or poorly labeled for real-world use. The result is a mounting pile of sunk costs, millions spent on cloud compute, consulting, and engineering with nothing to show for it but a canceled invoice. The numbers get worse as projects scale. By the end of 2025, 42% of companies reported abandoning the majority of their artificial intelligence initiatives, up sharply from just 17% the year before. Hallucinations, the tendency of artificial intelligence to generate convincing nonsense, have become a deal breaker for buyers. 77% of surveyed businesses now cite hallucination risk as the main reason for rejecting or limiting artificial intelligence tools, especially in regulated industries like finance and healthcare. Behind closed doors, Fortune 500 firms are trimming their artificial intelligence contracts, shifting budgets back to proven information technology investments. Information technology leaders describe a landscape where hype cycles outpace results and reliability concerns outweigh promises of transformation. The gap between what was sold and what was delivered is now impossible to ignore. As adoption stalls, the revenue pipeline that once justified sky-high valuations is narrowing fast. DeepSeek's arrival shattered the illusion that OpenAI's dominance was unassailable. In early 2025, DeepSeek's founders announced a GPT-4 class model trained for just $5.6 million, a fraction of what OpenAI spends on a single training run. Their model launched with a free tier, while OpenAI continued to charge $20 per month for ChatGPT+. The message was clear: the era of monopoly pricing was over. Anthropic, Mistral, and Meta's Llama models piled on, each closing the performance gap and accelerating the shift toward open-source, low-cost alternatives. For enterprise buyers, the difference was impossible to ignore. Why pay for a premium subscription when a free or near-free model offers comparable output and can be audited, customized, or even run in-house? The open-source movement, once a fringe idea, now threatened to gut the subscription revenue that justified OpenAI's $730 billion valuation. The numbers tell the story. DeepSeek's $5.6 million training cost undercuts the billions of dollars spent by incumbents. The $20 a month price tag for premium AI is already being bypassed by businesses and developers who see no reason to pay for a walled garden. Margins across the sector are collapsing as price wars break out and new challengers enter the field at minimal cost. The logic that once supported a monopoly, including proprietary advantage, scale, and pricing power, has evaporated. Investors who believed in an AI winner, take all scenario, are now facing a market where the moat is gone and anyone with enough data and compute can join the fray. NVIDIA's sudden 17% plunge on January 27, 2025, sent shockwaves through the entire technology sector. In a single trading day, $589 billion in market value vanished. It was the steepest one-day loss ever recorded by a public company. Market commentators scrambled for explanations, but the timing was impossible to ignore. DeepSeek's low-cost open-source rival had just gone public, and the narrative of endless AI profits began to unravel in real time. The impact didn't stop there. AI-focused exchange-traded funds, once the darlings of retail investors, have lagged the S&P 500 by double digits since the start of the year. The Global XAI and Technology Exchange Traded Fund, for example, trailed the broader market by more than 12 percentage points over the first quarter. Venture capital funding, which poured $23 billion into AI startups in late 2025, dropped to just $12 billion in the first quarter of 2026. That was a 48% decline. Insiders are reading the signals. Quiet waves of executive share sales have begun, even as marketing campaigns keep promising an AI revolution. Analysts who once called AI the safest bet in tech now warn of dot-com-era parallels, pointing to sky-high price-to-earnings ratios and thinning liquidity. Public confidence is breaking not in theory, but on trading screens and in the fine print of quarterly reports. The message is clear. When capital starts to flee, even the giants of the AI boom are not immune. Speculation alone cannot support trillion-dollar valuations forever. The warning signs now line up with a familiar pattern, one seen in every classic financial bubble. Hype surges years ahead of real revenue. Companies chase growth at all costs, ignoring the basic math of profit and loss. Infrastructure and energy bills mount, with data centers drawing as much power as small cities. The cost of top AI talent has soared, with compensation packages worth $1 million no longer rare. But the moat that once protected early leaders is gone. Open source models and price wars have turned proprietary advantage into a commodity, eroding margins and leaving even the giants exposed. Investors who want to survive this reckoning need a new playbook. First, avoid AI pure play, stocks trading at earnings multiples that rival the dot-com bubble. Valuation built on hope, not cash flow, is a dangerous bet. Instead, look to the infrastructure. Beneath the hype, power grids, cooling systems, and high-speed connectivity. These are the real bottlenecks, and they stand to benefit as compute demand grows, regardless of which chatbot wins the next benchmark. Scrutinize enterprise contract data, not marketing headlines. If real adoption stalls, revenue will dry up fast. Cancel unnecessary. AI subscriptions, free and open source alternatives are catching up, and consumer fatigue is setting in. Diversify away from any single AI platform. Wait for consolidation to reveal the true survivors. And above all, remember that technology can be transformative, but inflated valuations are never immune from gravity. The bubble logic is clear. The protective steps are too. Today, AI valuations still float on hope, not hard profit, while $115 billion burns and enterprise demand evaporates. The real reckoning is not coming. It is already underway. In bubbles, belief outpaces reality until the numbers force a reset. The safest bet now? Don't mistake hype for value. What's your next move?